Okay, folks, this is Patrick Zielbauer from Infinity Futures in Chicago. Thank you for joining us. We're here with Scott Andrews from InvestiQuant. I'm going to read through some risk stuff here, take a few questions, and we'll get right into it. So let's go ahead and do that. Firstly, trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So folks, basically, you've seen this disclaimer on our emails and all over the internet. That's because it's required, but it's also very important. All right, futures is a particularly risky kind of trading. There's no dancing around that fact. It's a highly levered environment. It's not for everybody. And if you ever have concerns about whether or not this type of trading, especially type of trading that involves leverage, is a good fit for you, please feel free to have a discussion with your rep in our office here. So there's a lot of people in here who do not have accounts with Infinity. You still have a representative assigned to you. That person is a Series 3 registered broker. A lot of the brokers of Infinity have been working here for many, many years. We have a really good handle on risk, and we're not shy about having discussions about whether or not this might be appropriate for a particular customer based on their personal circumstances. We will have an objective discussion about risk. So if you ever want to discuss it, please don't be afraid to contact us. We will certainly be happy to discuss risk with you. I'm going to take questions throughout the presentation. Matt from InvestiQuant is also taking questions. They're more geared towards his, InvestiQuant specific questions. We'll be kind of sitting in the background answering stuff. Scott's going to be doing the majority of the talking. But let me introduce Scott here briefly. So this is an event, the second event we've done with InvestiQuant. The first one was back at the end of January. It was sort of like our inaugural event. I would like to briefly explain what is actually going on here with InvestiQuant and Infinity, and just a brief explanation of the mechanics and really what is happening. So InvestiQuant has, and Scott will put this much more eloquently, I'm sure, but InvestiQuant, in short, has developed automated trading strategies and then written directly into our parent company's back end. For those of you who are customers, you're familiar with Transact, and these basically they're sending signals that Infinity is executing on our customers' behalf. So this is not like the kind of automated trading where you have to log in the morning and check to make sure your internet's working and check to make sure the charts are up and check to make sure your computer's not in standby mode, and then you got to turn it off at this time or turn it on at that time. The service that Scott is going to be talking about here as it relates to Infinity is what they call their white glove service, which basically means that all you have to do is subscribe to the system. Infinity handles the execution. So it's a very seamless experience for our customers because they don't have to log in and deal with the platform or deal with the fills or anything like that. We're handling all of the order execution, trade allocation. It all happens on our side. We have developed a very, very efficient process. It's been a very impressive process. InvestiQuant's developers have been extraordinary, and they've worked very, very closely with our developers as well, and it's really been an impressive undertaking in my eyes. So essentially what's happening is a customer of Infinity opens an account, funds the account. If you're a self-directed client already, you can open them up what we call a sub-account. You can have these trades happen in your sub-account. And it happens all on the back end. You don't log in. All you have to do is make sure you check your statements, keep your eye on your account, and that's the extent of it. It's not the same as you logging in and monitoring something on an intraday basis. So it feels very hands-off, and that's because it is. The purpose was to eliminate technology issues that are associated with individual customers dealing with computers. That's really the crux of it. That is really the undertaking that we have been taking on for the last, I would say, maybe a little bit under a year. And we now have several different portfolios that InvestiQuant will talk about that are being traded on a daily basis here. Some of them are geared towards slightly smaller accounts. Some are geared towards a little bit larger accounts. Scott, I'm sure, will highlight some of the differences. But that's what this presentation is going to be about, and how it relates to what InvestiQuant's mantra and their opinion as far as upcoming volatility. And Scott will talk a little bit more about that. But one thing I'd like to mention on a more personal note is that Scott and other members of Scott's team have been customers of Infinity with their own accounts for probably I believe over 10 years now apiece. And I can tell you with 100% certainty that this relationship would not have happened if that were not the case. Infinity is very selective in terms of who we work with, and we really enjoy the relationship that we've had with Scott and one of his main developers, David Scouron, as well. These guys have had accounts with us for a very, very long time. There's an element of familiarity there that you just can't develop, within a short period of time, and we are very comfortable with what they're doing, and that's the reason why we've gone this route. So we hope you enjoy the presentation. Scott, thank you very, very much for taking the time to do this out of your busy day. I know you're busy, and we very much appreciate that. So Scott, if you want to go ahead and take it away here, please feel free to do so. And folks, there's going to be a good discussion as well of hypothetical results here. Keep in mind, what happened yesterday might not happen tomorrow. Lots of the results you're going to see are based on hypothetical data. I'm sure Scott will address, the implications of that as well. Scott, go ahead and take it away.
All right, thank you very much, Patrick. Hopefully you can see my screen now.
Yeah, it looks good.
All right, and let me just change the pointer. All right, thank you very much, and appreciate the nice introduction there, Patrick. We do go back a very long time, and I can certainly say there are many good brokers in this industry. There are many good brokerage firms in this industry, but I don't think you'll find a better one than Patrick or Infinity. Like you said, I've had capital with them for a very long time. Our Vice President of Technology, David, has had money with them for over a decade as well also. So we're big fans. It's a great relationship, and we do think we're doing something fairly unique and disruptive in this industry, or trying to. That's disruptive in a very good way for you and everyone that's joined us today. So thank you for listening. I'm going to try to power through this. I can be a little bit long-winded because I'm very passionate about what we do, but I'm going to really try to go hard through a number of slides, and I love questions, so please feel free to fire away. As Patrick mentioned, Matt from our team will assist with questions and sharing links and so on, but I'll be doing answering every question. I don't skip questions unlike some people, so feel free to post. I may delay my answer, though, if I think I'm going to get to it later in the session. So if I do happen to miss your question or haven't answered it yet, please feel free to speak up and repost it or reference it, and I'll certainly get it answered before we're done today. All right. So without further ado, we'll rock and roll here. I think Patrick covered the risk disclosure here. I will be showing quite a bit of historical performance, hypothetical historical performance based on back-tested data. Everything I'm going to show you is being live traded, and it has been live traded for a while with real capital, not only by myself, but many members of our team. That said, I do have some hypothetical data before when we started trading, and you want to discount that. That's just bottom line. Hypothetical is always perfect, if you will, in terms of its hindsight. So real world never quite conforms to hypothetical historical data, but we believe it's by far the best way to measure any type of an edge, and I wouldn't trade without historical back-tested data, period. I haven't traded without that kind of data in over a decade, nor would I recommend it. You just want to use it with realistic expectations, and we'll talk more about that when we get into some of the performance of our portfolios. But today we're going to be talking mostly about volatility in the context of how to take advantage of it and how volatility-based systems can help you take advantage of it. But real quickly, just a little bit more background on myself so you can just sort of understand where I'm coming from and my views and see if they align with your own. I was fortunate to take a company public at a fairly young age back in 1999, the dot-com boom. The one big thing I realized was that there was a monstrous disconnect between the fundamentals of all those dot-com companies, including my own at the time, a company called SideQuest, and the short-term price action. So it got me very interested, but not in the way that you might think. And while I benefited from the euphoria of the 1999, 2000, 2001 timeframe, I also realized that I would probably never trust another analyst again, and I don't mean that in a bad way, but there are some conflicts of interest, as you know, and I became very interested, though, in short-term trading because I realized that fear and greed is really what drove and drives the market, even more so than fundamentals, at least on a short-term basis. So that's how I really got interested into it. Stepped down as CEO in 2002, had a little time and money, and thought it'd be a piece of cake to learn how to time the market and make, I don't know, 4 or 5% a month seemed to be reasonable. All I had to do was buy the dips, right, and sell the rallies, and I'd be well off and set and have this amazing ATM at my disposal. Well, we all know how that tends to work out. It's a lot harder than people realize. Timing the market is not impossible, but very difficult to do. And I quickly migrated. I was very interested in trading. I quickly migrated to trading shorter and shorter time frames because I could study them with a larger sample set, a larger number of instances. I also migrated away from charts and interpreting them and trading them on a discretionary basis to more of a quantified approach. I realized that I'm a mathematical person. I needed to trade facts. And just because something had happened on my charts the last 5 times in a row really had little to no bearing on it happening a 6th time. And I learned that the hard way, like most of you probably have as well. It's too easy to get fooled by randomness and recency bias and a number of other phenomena that happen when you're a discretionary trader and when you're using charts. So I've migrated to pure quantitative trading. I use robust historical analysis to drive all my decisions, and over time I've evolved completely to fully automated as well. So I'm delighted to be here to show you what I trade and what, again, many members of our team trade, and we'll introduce you to our portfolios in a little bit, but I want to talk about volatility more before we get started. And I guess right now, let me just introduce you also to my company, if I may, very quickly. After trading for about 5 years or so, I had a fair amount of interest from some friends and other traders in chat rooms with my research. I would share and publish it, and ultimately I literally was getting overwhelmed with interest in my opening gap trades. And I started a little blog called Master the Gap, as you see right there, in 2008, and it really literally just sort of took off, using a quantified approach to trading the open every day. Developed a big following, developed some great relationships with hundreds of clients, and had a couple express interest in me expanding the company to trade beyond the gap and to trade beyond the S&P futures, and it ended up raising venture capital from my own clients. Over 30 clients have invested literally millions in our company, and I guess that shows how much they believe in what we do and how it's worked for them, but also how much in need they believe this industry has for a better way of trading the markets. So I'm not here to tell you that InvestiQuant's the only way to trade and what we do with a quantified approach, but I will tell you that there's a lot of information out there that's not accurate, that doesn't work well, and a lot of inflated expectations set that I think ultimately crash and ruin the dreams of many good, honest, hardworking people. So we're trying to do things right with quantified edges, fully automated, that help individuals. So very excited to be here, and today InvestiQuant, we're a predictive analytics company. We create quantified trading edges that are fully automated for both traders and investors. We do have a trader side of the business, a platform if you're a real do-it-yourself kind of guy, but most or many of our folks have become fully automated, and a lot of investors need what we offer as well. So we're very excited to be here. And today we're going to talk about automated trading, but primarily in the context of volatility and how it can be your friend. It doesn't have to be your foe. If you've ever tried trading or you are an individual trader, you know what I mean. Volatility is one of those things that it gets you very excited, right? We see all the money that could be made in a given day or that you might make in a given day, only to give it all back the next day as your emotions start getting involved. So we're going to talk about our portfolios and how they overcome some of the limitations of humans and how they take advantage of volatility, and how you could take advantage of them if you're interested. So I think ultimately everybody's trying to do this, right? Make as much money with the least effort, the lowest risk, and the smoothest equity curve possible. And if you're not familiar with the term equity curve, it just simply means a plot, if you will, of all your historical returns, all your trades. You want it just to keep going up, 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 right, with no volatility, no losers, and so on. So we're all trying to accomplish the same thing. We all have different risk tolerances, however, and well, guess what? Trading done properly can help you do that. Done improperly, you can also lose a lot of money. So why automate it? Well, first and foremost, it helps you turn your capital more frequently. So one of the cool things about being a trader, and a lot of investors get excited when I talk about this, is that I rarely have my capital in the markets. I'm rarely exposed. I'm sitting in cash almost all the time, except for these very short-term trades. So when you're sitting in cash, you want to turn it as much as you can. It's like your inventory. So the more you can turn your capital, the better your chance of smoothing your equity curves and growing your and achieving your financial goals. Automated trading also helps you eliminate missed trades. Time and time again, I've worked with hundreds, if not thousands, of traders over the years. They miss trades, sometimes intentionally, which is part of their emotions getting in the way, other times just because they had an internet blip or their computer crashed or what have you. So it's a numbers game ultimately. If you have an edge, you don't want to ever miss a trade, right? Because every trade over time, if it has a positive expectancy, it means you're losing money. Now, automated trading helps traders diversify their capital, helps investors diversify their capital also. What we do is very unique. It's intraday primarily, at least on the automated trading side. We have some swing and overnight strategies we can talk about if anyone's interested. But it diversifies and sets a benchmark if you're a trader, right? So you don't have all your eggs in one basket, one technique that you're trying to master. If you're an investor, there are not many options to have access to fully automated intraday trading of futures. So it checks a lot of boxes in terms of diversification. And we tend to outperform, our systems, our approaches tend to outperform during the most volatile periods. And we'll talk more about that in a moment. And a lot of traders get to a point where it sort of becomes a job and they feel like all they're doing is babysitting the trades all day. They can't relax, they can't enjoy the family. Can't have lunch with the wife like I did today because they're too paranoid that something's going to go wrong or they're going to miss an opportunity. And with automated trading, you can let the algos do the work. Let your algorithms run at infinity, and we'll keep an eye on everything, and you can sit back and relax. And last but not least, I think I did a similar presentation a couple months ago. This was my first bullet because it's that important. But it's a good segue for this next slide here as well. Automated trading can help you get out of your own way. And that sounds harsh, but I honestly believe it's true. I'm speaking from firsthand experience. The biggest risk to most individuals' trading plans are themselves. They can't seem to get out of the way. They can have a great plan with a real edge, and then they undermine that edge by getting nervous. They get into a drawdown. They've had 3 or 4 losers in a row. They skip that next trade because they don't feel good about it, and sure enough, it was the biggest winner of all. Or they get greedy because they see all the giant movement when volatility kicks in, and they start loosening their standards. They take trades they shouldn't take, and they get a number of outsized losses, and now they're damaged emotionally and so on. It goes on and on and on. The list of mistakes that we as humans make. They're called cognitive biases, cognitive failures, if you will, and automated trading gets you out of the way. So a lot of advantages, and as I mentioned, maybe the biggest one is that the best time to be a trader is when times are volatile, when the markets are moving. However, it's also the hardest time because your emotions get in the way. So automated trading can be especially useful during the most volatile market conditions. So let's talk about volatility. This is an interesting chart from one of our co-founders, Rob Hanna, whom many of you may know. He's a fantastic swing and overnight trader primarily. And this is a chart he published. It's called 100-Day Historical Volatility. It's just basically a measure of the changes in price in the S&P on a day-to-day basis, measured as standard deviations. That's what the left or y-axis is there. And what it shows you, if you look closely down the bottom right where the arrows are pointing, the last time we were actually at the same level of 100-day average volatility was 1995. That's more than 20 years. Now, what's also interesting is look at the other two times that were close. If you look close, you'll see one of them was in 2007. We know what happened in 2007, right? That was the peak of the equity markets for a number of years. That was right before the financial crisis. And another more recent example was fall of 2014, right before the markets topped out and got pretty choppy and went sideways. 2015, volatility picked up also, and I'll show you another chart on that in a moment. So we think, and it's not just us, but many other market pundits, if you will, believe it's just a matter of time before we get another spike in volatility, and it's probably right around the corner. So that's good news. That's actually outstanding news, and it's probably why we've had so much interest in this particular webinar. So let's talk about volatility in the context of systems, though, because a lot of people get confused about the interplay, if you will, between volatility and making money in the markets, because it is a little bit different than you think. And one point that a lot of people don't even realize is that volatility tends to happen when the market's going up, sideways, or down. I'll take a drink of water. Someone answer that question for me, or a few people. Weigh in. What do you think? Is volatility likely to be higher when the market's uptrending, sideways, or down? All right, I'm getting a number of answers here. Keep going. Well, we got votes for all of them, up, down, and sideways, and the right answer is down. So if you go back and study volatility, the biggest spikes in volatility have occurred when the markets actually were going down. The biggest range days tend to happen when people get fearful, frankly. So the way I think about it is fear is a much greater or stronger emotion than greed in general, at least on an acute basis. So when the markets tend to act that way, when the market starts selling off, you'll often see the absolute biggest moves are to the downside, not to the upside. And then you'll get a series of days. You'll get this V bottoms, and then we'll grind our way back up. Volatility will slow down. And in fact, we've been in a very low volatility environment of late. Christine's making a good point here. Volatility does start from the highs, right? So the volatility goes down, the markets, they stop going straight up, they start going sideways, volatility starts to pick up, and next thing you know, it explodes. And that's what generally happens. But let's look at it in the context of what's happened the past 3 years, and I'll put in the context of the past 3 years, and we'll look year by year, if you'll just bear with me, and I will compare that volatility relative to the performance, and this is hypothetical performance, of our $50,000 portfolio. 50K portfolio, you can trade with less capital, you can trade with more capital. It's just a group of 8 strategies, of which 4 can trade in any given day, okay? And we'll talk more about them in a moment. I really just want to make the point of a portfolio of individual strategies and how they performed, and they use volatility-based stops and volatility-based targets. So when volatility is higher, they use slightly bigger stops. When volatility is smaller, they use smaller stops. And they go for bigger targets when volatility is higher, and they go for smaller targets when volatility is smaller. But let's look just for, broadly speaking, this chart of 2014. The left axis here is just a hypothetical account value, portfolio value. It had once started with 50,000, I think it was 2012. It would have been, hypothetically speaking, around 65,000 at the beginning of 2014 with pretty modest leverage in our book. So that's the left axis, and that is represented by the blue. These are individual trades throughout the course of the year. And you can see it worked its way sideways for most of the year. It's a little choppy there for the first 3/4 of the year, and then took off to the upside in the fourth quarter. Well, what happened in the fourth quarter that was different? Well, see this gray line, the little choppy gray line that's bouncing around the dotted gray line? Probably should use a different color. Once we got above the dotted gray line on a sustained basis, that's where you saw performance kick in. So for the fourth quarter, almost the entire fourth quarter, the 10-day average volatility was elevated. It was above this mean level of 16. Very good in general for all of our volatility-based systems, not just this one. It's all of my trading, my entire trading style has always been more productive, more profitable, that is, in the higher volatility periods. And this is just a great example right there. It just chopped around sideways, didn't do much while volatility was sort of low, hanging around the 16 level. And looking at a couple more comments here. Rod says the market seems to climb like a staircase and jump out a window. Yes, it does. But thought about, here's a good question. Phil says, have you thought about using a volatility filter for your trading systems? Only trade when volatility is higher. Yes, you're a little bit ahead of me. I'll come back to that one, Phil. So if I don't, please remind me. But in a few slides, I'll talk about that. Rod says, what does the dotted gray line mean? How is it derived? This is a 10-day average volatility. This is actually the average true range over 10 days. It's a real simple measure, pretty standard in most technical charting applications. And just simply a measure is, are we getting sizable overnight gaps and sizable intraday volatility or not? It's just a crude metric. In fact, it gets clearer because 2014 ended up a decent year for the 50K, but it was almost all in the fourth quarter. Let's go to 2015. So it picks up in fourth quarter 2014. In fact, remember I said it reached its near low, that prior chart was in fall of 2014. Historical volatility, a slightly different spin on volatility, reached its, nearly reached the same level it is now. And then you see what happened there. 2015, look what happens. Almost the entire year, the performance of the 50K portfolio climbed higher. In fact, it climbed sizably higher. So it was making significant gains almost the entire year. Now, was volatility smooth? No, it never is, okay? So that's not the point of the gray line. But where was it in a relative sense to sort of the important 16 level here? Well, it was above it almost the entire year. 99% of the year, it stayed in this elevated state. And think of it this way. If the market's not moving intraday, you certainly can't expect to make as much money. You can make some money because you can risk less, but your average trade, your average expectancy is going to be lower in those low volatility environments. And I've had very good years in low volatility environments. It's just harder, and they're not as consistent, and it's hard to predict how it's going to work out. But as volatility tends to increase, performance tends to increase also. So this is, a nice, clean, fantastic example. 2015 was a great year for trading volatility-based strategies. Moving on to 2016, what happened then? See the gray line here? Start off very high, the ATR. If you look way over here, the scale was almost 30, 28 to 30 at the beginning, and only climbed at the beginning of last year. It even got to 42. That was 42 points in the S&P 500, about 3 times what it is right now for the first quarter of last year. Does anyone remember what happened to the broader index in beginning of 2016? The first quarter of 2016? Everybody have a chart up? It was wild, huge swings, and what did it do specifically that it hasn't done in a while? It sold off. It was down 10% in the first quarter. Well, while it was down 10%, my own live money trading was up more than 10% during that exact same time. You can see this particular portfolio, let's see if that math works. I know my own live trading, I was up actually 16% first quarter of last year. That's the good news. Bad news is it was almost all of my gains for the entire year because my own trading mimicked this particular portfolio, and most of our portfolios have gone sideways since then, sideways to even down from the peak, which was in late spring, early summer. And why would that be? Well, volatility-based systems tend to perform better when volatility is higher. So what happened after first quarter? Volatility started shrinking, got down to that 16 level, and then we chopped. We were above it at times. It just didn't make any headways. So it's not a direct 100% correlation, but it's a clear correlation and relationship between overall volatility being elevated versus being lower. When it's lower, you're more likely to be sideways. I'll talk about what's inside the portfolio in a little bit. And let's see. Yeah, Tim says it was down 10% for the length of the time it took for a long nap, and then it made new highs. Yeah, it was down not even the whole quarter, right? It was down maybe 6 weeks. But it was a scary time for people that were long only, and that's frankly why we've had so much interest from passive investors in what we're doing. They recognize we're not traditional market timers. We're not trying to pick tops, not at all. We trade our portfolios, and they take advantage of volatility by definition of what they do. So when volatility picks up, they tend to outperform. That tends to be during sideways and bear markets, which makes us or our portfolios a very attractive option for a passive investor who wants protection but doesn't want to sit there and keep shorting. It doesn't want to have money exposed to strategies that short continuously trying to catch the next top. We're not big believers in that, and that can be an expensive way to capture the next move down. And then this year, this is not to scale, but if you look closely, this is about a $1,500 range. So the 50K portfolio has just been chopping sideways all year. In fact, most of our portfolios continue to chop sideways. So it's been a long year, not just year to date, but going all the way back to middle of second quarter last year. It's been an unusually long period, a little bit frustrating for these types of strategies and these portfolios. And we've reached that low that we haven't seen since 1995. So the question was, well, what could you just add a filter, like a volatility filter? Is I forget who mentioned that. Just asked. You can, and you're going to miss. Unfortunately, it's not a perfect correlation. If it was perfect, and there's perfect correlation, then that would be a simple way to do it. But it's not. It's a little more complicated than that. There have been years when our systems do very well in low volatility, just not as well as they do in higher volatility. So in general, my belief is, it's better to be exposed to the market and not try to time it, because if you wait, if you missed the first 2 months of last year, or even the first month of last year, you missed out on a lot of gains that represent the bulk of the gains for the year. And so I use this, and hopefully this is maybe setting your expectations as well if you decide to move forward with this. Keep your expectations low and lower volatility. Don't try to time when it's going to happen, but you know it'll happen at times, and can't guarantee that they'll perform, but in general, odds are in your favor that you'll be happy that you were exposed to the volatility in advance as opposed to waiting for it. I'll get to some, and let me just power through how our portfolio is exclusively in futures. Currently, that short answer is yes, but we're going to get to exactly what's in each one in just a bit. And if I've missed your questions, because we've got a number of them, I'll come back to them. So, here's the question of the day. When volatility rises, will you be ready? Obviously, it's a loaded question. We think one way you could, and at least should consider being ready, is through automation, so you can get your emotions out of the way and not have to try to figure out how you're going to tackle volatility when it arrives, but to already be embraced with a strategy or a technique like automated trading that can take advantage of it for you. So that's part of what we do. The automated portfolios are the evolution of our company, something that's very exciting. We started automating about a year and a half ago. We've been in business since 2008, and our market adapting algorithms, actually they're self-adapting as well. They're highly adaptive algorithms, monitor the markets for you. So they're rules-based. When certain conditions are met, they automatically execute, and they're co-located. We're all, if it wasn't clear to you through Patrick and Infinity, technically there's an electronic handoff, if you will, from us to Infinity and from Infinity to your account. That happens in milliseconds. It is hands-free. There's not manual intervention in any of this. This isn't the old newsletter business, or they call it letter. It's technically letter of direction business, but it's not newsletter business where we're sending some rules to Patrick by email or calling him saying, hey, we've got a buy at the open today and put your stop here and an exit here. It's none of that. It is fully electronic. The Infinity and Transact, very sophisticated technologically, and so are we. So my first company was a technology company, and it's been a great marriage in that regard. And
hey, Scott, I want to comment one thing about that. Okay.
Please do.
So one time as a test for this, guys, just to comment on to reiterate what Scott was saying, we have done a lot of, we do obviously in our side of the business, we do a lot of measuring about execution speeds, and that's obviously very important to us. So we did some testing with, a lot of these signals fire, especially obviously the ones that are trading the indexes, fire right at the New York stock market open at 8:30 Central Time, 9:30 Eastern. So we have done some testing where we track, how quickly, we see the order being sent and filled. And we have seen several instances where 8:30 and 0 seconds occurs. And in that time, InvestiQuant's technology makes the decisions that Scott's referring to about whether or not the trades are going to take place. The signal is sent electronically through the technology that InvestiQuant and Transact have built. The order is placed at the exchange, and a fill is received still at 8:30 and 0 seconds. So there is no doubt that execution speed, I mean, the equivalent of something like this is, to me, it's very much the way a fund operates. I mean, for the kind of execution speed people are getting with these trades, I just think it's atypical for what our customers are paying for example, to be able to have access to something like that. So that's one thing I'm very proud of on the brokerage side, is because we have really been able to speed up the fills. And as Scott mentioned, the co-location is a big deal. Their stuff is hosted here in Chicago, not where they're located physically. So that makes a big difference as well. It's pretty neat.
Yeah, Patrick, thanks for saying that, and I'm glad to hear you get as excited as we do. My technology guys literally have measured it to the milliseconds, and I won't say exactly what it is, but I assure you it is in the range of well under 0.1 seconds. I mean, it's basically instantaneous. It's unbelievable how fast it is. So very cool. All right, let's keep going. But ultimately, fast execution doesn't really make you money, right? I mean, it does make you money, can keep you from losing money, but ultimately it's all about the edge that's underneath the engine, or the engine underneath the hood, right? So our edge is based on predictive analytics, not just back testing. It's using history as our guide, if you will, but with very robust historical analysis of a very large number of market condition considerations, metrics. We can measure, and we organize them loosely into trend, momentum, volatility, overbought, oversold, and seasonal considerations. Lots of considerations organized. And by looking at how different market conditions have impacted the results of different strategies, or said differently, how different strategies performed under the current market conditions, we can paint a profile, a probability matrix of what are the odds of achieving a certain target with a certain amount of risk today. And if that meets our minimum criteria, it takes the trade. And that's, for lack of better terms, we call that predictive analytics. Now, this technique itself of using multiple groups of systems is called ensemble forecasting. It's a nerdy term. We didn't invent it. But I think it actually started in the weather industry, forecasting hurricanes, actually, believe it or not. And if you think about it, people a lot of times I'll use the weather analogy, and they'll say, well, Scott, my weatherman's not very good. Half the time they say it's going to rain, it's not going to rain. Well, the weather's awfully complicated, right? So are the financial markets. Financial markets are way more complicated than people realize. But here's the deal. The weatherman can't predict very well at all what's going to happen 6 months from now. If you tell him what's it going to be like in a month, he's still not going to do a very good job. If you ask him what's going to happen tomorrow, he's got a pretty good idea what's likely to happen tomorrow. If you ask him at the beginning of the day what's likely to happen in an hour, he's incredibly accurate, right? Well, that's the same concept of what we're doing. We're using ensemble forecasting, multiple robust, sophisticated systems to predict in real time. We're doing it right up to the open, precisely based upon the opening tick of the open, and then we can predict what's likely to happen. And that's why the time and the lack of latency, minimizing that latency is so critically important to us. It gives us a predictive edge. Now, with all that said, we can adjust win rates based upon stop sizes and all that. We don't try to do that. We do try to have strategies that generally have 50 to 70% win rates. That tends to be the way it works out, but you make a lot of money with lower win rates. So we don't put a lot of emphasis there. It's all about the edge, how much do we have to risk versus what do we stand to gain, and what are the probabilities of those two potential outcomes. And that's what we do. And by the way, again, we didn't make up this idea of ensemble forecasting. It's been around a long time, but I will say, just as a quick side note, we have taken our core systems and had them tested by the Center for Quantitative Modeling at Duke University. The director there is a gentleman named Daniel Egger, and he is on our board of directors now, and he's also an investor in the company now. And he became an investor after they did this big research project for us, validating our approach and our edge. So we're proud of that. The whole point is we are a company full of technologists, but we're really a trading company. We have 6 traders on our staff. We're all involved in the development of our edges and continually refining them, and we have access to world-class talent right here in Raleigh-Durham, North Carolina from Duke University, and another company called SAS, Statistical Application Software. It's the world's largest software company, 13,000 employees in beautiful Cary, North Carolina, 3 miles from where we're located. There's a lot of talent that knows a little bit about statistics and data mining and predictive analytics. So it's a great blend, and that's what we do and what we're trying to do. So what's included? So there's been some questions about a portfolio, an IQ portfolio. Well, first off, it's a compilation of multiple individual strategies. They are currently, the existing portfolios are all intraday focused, meaning there's no overnight risk whatsoever. They're all trading futures, either index futures or bond futures. Each portfolio is of different sizes, and everywhere from what we call a $25,000 portfolio up to a $500,000 portfolio. So they have varying units being traded here, various markets. So the 25K trades the least amount of markets. It doesn't trade all these. It's not big enough. The 500K trades everything. So, but this is a sampling. This isn't the only markets we'll be trading, but these are some of the more liquid ones, and the less liquid ones we use more sparingly. But most of it's around the index futures and the bond futures there, those top 4 that you see. One of the things that's different, we have lots of things, and again, I know I don't want to sound like I'm selling, but I'm very passionate about what we do. I believe in what we do, and this industry is lacking in quality systems. Many systems make a little bit of money and then end up losing a lot of money. It's a tough business. It's tough to automate strategies and rule sets in a way that can consistently beat the markets. But one of the things we do is overcome what I think is one of the big areas of opportunity, or one of the big limiting factors for most systems, which is risk management. And I'm not saying there's no risk with our systems, so don't get me wrong, but we do take a very thoughtful view of how to capture alpha, profit opportunities in the markets with our algorithms while minimizing risk. So we have what we call a risk management overlay that sits on top of our strategies that basically throttles the risk when volatility and risk starts elevating to points that are mathematically problematic, or potentially problematic, I should say, to even turning them off during the most extreme periods of volatility. And they did turn off, again, hypothetically, because we weren't trading these exact systems back in 2008, though I did have my own system I traded called Pearl back in that time. Actually, it was Otis. Otis was the predecessor of Pearl, my own mechanical system that I traded back in the time, and I had a tremendous year. And I've shared those equity curves in the past. But our risk management will turn off the algorithms if we get too elevated. And it's not because the risk is greater in terms of what's happened historically, because historically we've done tremendously well. And in live trading, I did tremendously well during the most volatile periods. But we don't want to subject a portfolio to a random sequence of trades where, any random combination, a little bit of bad luck, random series of trades at very elevated volatility. If you're risking too much per trade, or you have to risk too much trade to capture the opportunity, then it could expose you to way too much risk on a daily basis, a weekly basis. So they will go quiet, but there's plenty of periods during bear markets and volatile markets where you'll get a spike in volatility, that's really extreme, and then it settles down, and that's the sweet spot. That's what we're shooting for. Let me see. Question was, volatility gets the greatest weighting among our systems? No. Well, volatility is a big part of all of our systems, but the system itself, volatility, I think, is it's a different way of, you can use volatility to predict when expansion is more likely, or a range expansion, where you can get a big outsized opportunity versus contraction. And that's what we mean by that group of systems. What is the expense percent for different portfolio sizes? Harish, if you're asking about the cost of them, we'll get to that in just a little bit. Well, we've got an office not far from Durham. We've got a client actually coming by tomorrow, Tim, so you're welcome to give us a shout and come by and say hi. Just one thing, this is a long-time member. We do have a trader side of our business where we use our platform and discretionary trading tools, the quantitative trading tools that are used on a discretionary basis. Coco, K.A. here, is former professional trader, Morgan Stanley, longtime client, and these were his words, not mine, and I'm not sure I'd like to say it exactly like this, but there's some truth to this. You're doing the work of a back office hedge fund at essentially goodwill level prices, and they're goodwill level now. We hope they won't be goodwill level forever, but we're a year and a half into automation, and we think we're doing some pretty exciting things, and we do have some introductory pricing. I'll talk about that in a moment. So the portfolios, real quickly, we have 4 categories right now: 25,000, 50,000, 200,000, and 500K thousand. That's an assumed starting capital. You would need to talk to Patrick or one of the brokers at Infinity to find out the right size for you. And it really gets down to your risk tolerance. But using those assumed metrics, you can see 1-year returns. Now, how many people get excited about those? If you're a trader, probably not many. If you're an investor, even those aren't very excited, right? If you're a passive investor. But remember what I said. This is the past year during a very low volatility period. If you go back and look at the recording, I think it's on YouTube from Infinity, that I did a couple months ago, you'll see the first quarter from last year was included, and those numbers were much elevated. So when volatility kicks, I do expect, can't guarantee, but do expect that you'll see these returns improve a lot. Lifetime returns are going back to the start date. It's the first trade date. And again, this should say it, and we missed it. Matt, if you're listening, we need to make a note. These are hypothetical historical performance results. We were not trading, and that needs to be disclaimed here on the slide. We were not trading these exact systems in 2012. I like to think what we're doing in these systems is better than what we were doing in 2012. But I just want to be clear on that. And that's what the lifetime return is. Since then, divided by number of years, basically, you get the average annual return. And again, this is with low leverage. We're very, very conservative. You can use more leverage. And just for you traders, they're assuming 1 contract per about 10,000 in equity. So that's a very low margin ratio. We're not using, I think you can day trade futures at Infinity for 2,500, 3,000. Is that right, Patrick? I'm not saying you should, but we're not touching anywhere near that kind of leverage.
Right. I definitely want to comment on this part of it, because this is particularly relevant to people who have understanding of the risk of trading futures, because what we've found is that most of the people who are participating in these portfolios now have trading experience, many with us. So when our customers open accounts with, let's say, $20,000, very rarely is the customer who puts $20,000 in the account always only trading 1 contract, maybe 2 contracts. Usually our customers are trading with a little bit more leverage. And again, leverage, as Scott said, can work for you, it can work against you. But the important thing to remember about the assumed capital amounts that you're seeing here is that that is what the performance metrics are based on. It's not the actual minimum you need to trade these markets. So as an example, the 25K mini, the performance metrics are based on 25 grand, right? But it only ever trades 2 lots at a time. It's never trading more than a 2 contract position. So if you've been an account holder with Infinity, you can trade more futures contracts than 2 with $25,000 and still not be considered dramatically over levered in most, in the eyes of most active traders. So what I'm getting at is that if somebody wanted to participate in, say, the 25K portfolio, but they wanted to do it with $12,500 instead of $25,000, from a risk perspective on the brokerage side, we would be okay with that because we have clients who are trading way, way more aggressively than that, right? So if you are okay with the risk and understanding that the performance metrics that you see on the site are based on 25, therefore they would be doubled should your account achieve the performance that's shown on the IQ website, then it might be okay for you. So in other words, like if they make 10%, you've got half the starting capital, you're going to make 20%. If they lose 10%, you're going to lose 20%. So you just want to understand the math. And this is particularly important with some of the bigger portfolios, like the 200K. If I remember right, I could be off by a little bit here, but I'm pretty sure it only trades, I think
10.
maybe a 10 lot, right, at the most, right? So that's one contract per 20 grand. Based on our risk standards, you could easily trade, that 200K portfolio with, $100,000 or less. I mean, maybe, significantly less in some cases. You just want to be comfortable with the risk, and you also want to be okay with the idea that if there is, again, we hope there isn't, but if there is a protracted or, somewhat violent drawdown, that you might have to, margin your positions a little bit at some point. So you don't necessarily have to have the assumed capital in the account to take these strategies. You just want to have a good, firm understanding of the implications of not doing so. So that's our department. That's not a discussion you have with Scott and his team. This is individual, discussion with your representative here. The way, I'll just mention this now while I'm on this topic, is InvestiQuant has nothing to do with your futures account here in terms of like the balance of the account or anything like that. That's not their business. They're just giving us the signal. We're the ones handling the risk in the trade. So this is the discussion you would have with us. So
Well said, Patrick.
Okay, cool. Go ahead.
That's exactly right. We're the strategy developer, and Patrick and his team helps you manage your risk and the appropriate size. And all these metrics, like he said, just to summarize, are just based on an assumed capital as a point of reference. That's it. We tend to be very conservative. And you can see trading the leverage that we were just talking about very conservatively, they have not had large drawdowns on a percentage basis. If you do the math, that's 2,400 on 25,000, so not quite 10%, maybe 9%. The 50Ks had about a 7% worse drawdowns from the equity high to the equity low. The 200Ks had a 9,000, it's about a 4.5% drawdown, and then the 500K, that's actually, 6%, a little bit more than that. But two things I want to point out on that, because I don't want people to get too excited about what Patrick just said, which he's saying you can trade more leverage if it's appropriate. You talk to your broker about it, and you have the risk tolerance. But I do want you to keep in mind, these are indeed hypothetical drawdowns. And because we're only going back to 2012 or 2013 on the equity curve, you have to recognize that this is probably an understated number for what you're going to realize at some point in the future. I don't know if that'll be this coming year or 5 years or 20 years from now, but the worst drawdown probably hasn't happened already. In fact, it's way more likely to happen in the future. And I'm just being very direct, because the way to make the most money in the markets over the long term is to stay in the markets over the long term. Don't blow up your account. Don't do financial damage, and don't do psychological damage. That's probably a bigger risk than people realize, an equal risk to financial damage. Psychological damage, because you trade it too aggressively. So I tell people what I do, and this is just me, I assume this number here is going to be 2 to 3 times bigger, the actual drawdown. And it could even be more. But for planning purposes, that's the way I think about it. And if it's more than that, I'll call that my uncle point, and I will adjust accordingly if and when we get to that point. So that's a good conservative way to think about it, in my opinion. That's how I think about it. And let's go to the next slide. Oh, a couple questions. I missed one. Someone said, sort of a dark question, but how do you think the system would fare in case of all-out war? Let me just put it in context of extreme volatility, which is what would happen, right? The markets would sell off. Our strategies are intraday only. They have volatility-based stops that are a small portion of the average daily range. So in any with any whiff of volatility against a position, it's going to stop them out. So I could never say never that the markets would, if the market stopped trading instantly and you're exposed in a trade, then I guess, and we open up 2 weeks later to the downside, yeah, I guess you would technically have some exposure. But that's the kind of stuff that I think we all have bigger problems. That's nuclear war kind of stuff. And the odds are extraordinarily low. I think any kind of whiff of bad news, the volatility starts selling off, our stops will get hit. If we're on the wrong side of the trade, could hit your target hit as well. So I just don't worry about that. In fact, to the other side of it, I say that's exactly why everyone should have some exposure to intraday only portfolios like we offer. Because what if you're long? What if the bulk of your wealth is tied up long in the stock market? You could wake up in a day or two and be down 20, 30, 40%. Anyone know how much the market sold off or remember in 2008 from the equity highs of 2007 to the bottom in March of 2009? Do y'all remember the percentage? We're only going back 10 years here, 9 years. Remember what that equity? 40%, pretty good guess, but too low. Marvina's in the right ballpark. It's more than 40%. Everybody's probably Googling madly. Well, I'll tell you, it's 56%, I believe was the correct number. 56% correction. Think about that. People say it couldn't happen again. Why not? Seriously, why not? Volatility is ahead of us. The average, Rob talks about this, our VP of Research and co-founder, I think the average, there's all kinds of metrics all over the web on it, but a correction is considered 10%. Average bear market has most of the time been over 20%, many of them over 40%. So it's not unheard of going back in time. So a little food for thought there. And there was one other question, two comments. One, it doesn't look much better than a mutual fund. Not trying to look better than a mutual fund over the past year. If you look back in time over our types of strategies, you'll see we have a much better return to risk profile, right? So the stock market's done really well of late, but you have to look past the fact it had a 56% correction in order to capture all those returns. And I know we all have neighbors and friends and family that sold near the lows and missed out on jumping back in and missed a lot of this run-up. You took some enormous drawdowns in order to achieve the returns of the stock market. So we're a diversification play that can actually help you take advantage of those volatile periods. Frankly, if we keep up with the bull markets, a raging bull market, I'm happy. Modest double digits, thrilled with that. Even single double-digit returns during a bull market, I think is probably appealing to most investors because you've got lots of way to make money in a bull market. It's when the market goes sideways or down that a lot of investors get hurt. Why didn't you back test further? Greg, a good question. So we require 10-year window of data. So all of our signals are using 10 years of data or about 2,500 trades in order to have robust statistical analysis of all the different market environments. That's about how much we need. So you take 10 years plus whenever that 10-year period ended. So these strategies basically start 2012 and beyond, and that's because I know the S&P futures go back to 98. Those can go back further, but things like the NASDAQ, I think is the limiting factor. Good data wasn't available until 2002. And Rod says, I understand why the more capital you've placed, the lower the return. It seems to me you shouldn't put in more than 25,000. Well, again, we've had incredibly low volatility. In general, the bigger accounts will have lower returns and lower percentage drawdowns. Remember, drawdown generally goes down. I mean, that's how much risk you're taking goes down. You can make more with a smaller account if it has the right strategies in it. But in general, I tell people the smaller the account, the more volatile your returns are going to be, which means you're going to have bigger swings in your account equity to the downside, followed by periods of probably bigger moves up. They're going to be more volatile. Whereas you get in a big diversified account like the 500, this could be more of a steady, smoother equity curve because it's trading many more different strategies. So your risk-adjusted returns are going to be far greater. And that's the name of the game. What is the typical intraday holding time? Hours, minutes? You always make a decision at the open. The algorithms are, yes, using information up into the actual open before they pull the trigger, because it's based, a lot of our algorithms are looking at size of the opening gap and the direction and its actual location relative to some key technical levels that we have found to be very important over time. Typical intraday holding time, hour and a half. So here's an example portfolio. There's much more detailed information on the website if you go to InvestiQuant/infinity. Pretty typical, 60% roughly win rate, make a little bit more than average daily loss. That can vary. Periods of sideways to up, sideways to up, sideways. And hopefully this little bottom here was the bottom of the next leg up as we start to get some volatility. I have no idea though. I believe that's going to happen, but we'll see. So the white glove service, I think actually Patrick covered this quite well, so let me just fly through this. But bottom line, it really is akin to what Coco and that former quota said. A testimonial from a client, one of our clients in our trading room called, we're like a back office hedge fund trading your account. Our algos are being executed electronically, seamlessly by Infinity in your account, all super, super fast. The good news is you don't have any redemption fees. You don't have to lock up your capital. You can turn off your account. You can close your money, take your money out. You control your money. And you get to see what's going on. Every day, end of the day, you get a statement. You know exactly what's going on in your account, what happened that day. So it's sort of the best of both worlds. You maintain total control and visibility while you still get quality hedge fund-like performance working on your behalf at, we think, a more than reasonable price. It's hands-free and worry-free, as Patrick also mentioned. You're not having to do anything. You don't have to turn on your computer. You don't have to make sure your applications turned on and opened up, that you've got power or anything like that. It's all done behind the scenes for you. So if you're a trader, you can keep trading, doing exactly what you do every single day without any regard. Or if you're a passive investor, you don't have to worry at all either. I do encourage people to keep an eye on your brokerage statements. I don't think you need to watch every single day. Nothing wrong with that. You want to keep an eye on where you are, because they just won't, the way they're geared, they're just not going to make a ton of money in a day or lose a ton of money in a day. That's relative, I'm sure, but just keep an eye on whether you're in an equity run-up, an equity drawdown, have your uncle point, and leave them alone, and just use it as a form of diversification. Couple more questions. Hold on, actually several questions. How's a negative return greater than a positive? Rod, it's not. You're looking at a snapshot of 12 months of time for the strategies in play. So the 25K portfolio only has 4 strategies in it, 2 of which can trade in any given day. Those 4 strategies happen to have done better than the average of the 40 or 50 strategies in the 50K over the past year. But it's a very small period of time with very low volatility. And as we've said many times, past performance is not necessarily indicative of future performance. So I wouldn't get wrapped around and judge anything on 1 year of data. I really wouldn't. I'm not saying the 25K is not going to do better. I'm just saying that the returns will be choppier over time. That's just the way they're set up, and that's actually the way all financial products work. The more diversified, the smoother the returns they are over time. Any given small individual strategy, can make a lot more than any of those. But you can't pick. You will only know what the best strategy to trade last year after the fact. And if I could pick which one would work best in the coming year, then yes, we'd all trade just that single one, right? And we'd sell it for lots and lots of money, or just print money. You just put it into a fund and exponentially grow our capital. It's just not the way the real world works. All those returns shown up there are inclusive of commissions. In fact, I'm glad you brought that question up, Lawrence. They're inclusive of commissions, slippage. They are not inclusive of our actual fees, which I'll get to in just a moment. So you want to discount that a little bit. Have we simulated returns during that time? Yes. Well, and actually, I was trading live. I've done thousands of futures trades, and I have systems with live performance data, actual trade performance data during that time. And we have simulated. We know exactly how frequently they trade. The risk management still generated significant returns, but kept you out of the most, what we call the most dangerous situations. Oh, I take Matt's correcting me. The fees are included in those returns. I'm sorry. Okay, so we didn't used to include the our actual fees in there. So the fees are included. Sorry about that. Thank you, Matt, for clarifying that for me. And I've got a slide coming up, James. Just hold just tight, and I'll show you the fees. And again, the performance is going to vary year to year by portfolio. In general, the ratio, and this is the most, I'll say it one more time, the most important thing to understand, Rod, is that over the long term, several years or more, I'm highly confident that the ratio of run-up, meaning the amount of capital that would be made by the larger portfolios relative to their drawdown, their volatility, which is really the most important metric to pay attention to, that is going to be the best ratio is going to be with the larger, more diversified portfolios. Because if you have a really good ratio, a high return, low risk ratio, then you can trade with more capital. Where you might make more money in absolute terms, but you're going to have bigger volatility, so timing and all that. So we can take it offline. It's sort of a hard concept if you're not familiar with it, but it's just mathematically the way it all works. Not just us, but with everyone. We will be sending out the PowerPoint, and the recording, I think, will be coming from Infinity, and I'm not sure who's sending the PowerPoint slides, but yes, we'll get that to you. All right, so just real quickly, because we're getting a little bit long here. Wow, it's already been an hour. So we're almost done. Portfolios been traded not only by myself and our team, but also our board of directors. We have over 30 investors. Oh, we got a typo there, 2 N's, sorry about that. These exact same concepts of my nickname is sort of corny, but I got the nickname The Gap Guy a long time ago, about a decade ago, when I had a blog, and it sort of stuck. So a lot of these are based on the opening gap, so these are concepts and techniques that we just didn't stumble on or data mine. We've been trading these things for years. We are very selective. They are adaptive to market conditions, adaptive to volatility, and adaptive to even their own performance. That means if a strategy stops working inside of a portfolio, meaning it's no longer showing a compelling historical edge, it stops trading it. It won't trade it again until some more trades get accumulated that were winners that turned it back profitable to meet our internal metrics. So now with that said, they're not super sensitive. So I don't want you to think, oh, I'm in a drawdown, I don't need to worry about this because they said they'll turn it off if it gets in too deep of a drawdown. Too deep of a drawdown is a personal thing, right? They're not tuned in that way to hit some certain drawdown. Not that they couldn't be, and not that we're not working on those concepts, but they're not that sensitive right now. Generally they hit certain performance metrics, they'll stop trading. That may be above or below your own personal risk tolerance. So you want to keep that in mind. And we're not traditional. Most system developers, if not all of them, all do optimization. They try to find the right moving average, the right stop size, the right target, the right indicator value, whatever they're using, RSI, MACD, whatever. We don't do any of that. Our strength is taking core setups, and we apply multiple systems that evaluate market conditions, and we simply look at what has worked. Has this combination of market environments worked for some sort of pre-established risk to return ratios? Very different, very non-traditional approach. And then last but not least, we have limited inventory, and that sounds a little weird too, but if we let everyone in the world trade these things, they'd stop working. And you might think, well, wait a second, Scott, you're selling them. Don't you want you just sell as much as you can? Well, if they'd stop, people would stop buying them if they stopped working, right? So if we sold too many of them. And B, maybe it should be A, is that we're trading these exact same portfolios, exact ones. So we are trying to grow our capital as aggressively and as safely as we can as well, and we want them to continue working. So we do have limited inventory for each portfolio. Now we will have other portfolios down the road and so on, but you know, you're going to miss out if you try to wait, I guess is the point. Here's the pricing. It varies a little bit. Each one you can pay for annually upfront or per quarter. We encourage a longer time frame. We used to offer monthly. Monthly doesn't work because everyone signs up for a month. They said, oh, it only made me 4% last month, or I lost 4%, or whatever. They judge it on the wrong metrics. What we do in a given month really doesn't matter. In fact, frankly, what we do in a given quarter really shouldn't matter to you either. But we acknowledge that it's a lot of money, and you may not want to make that decision all up front. So you can do it per quarter or per year. You can have it debited from your account at Infinity, or you can pay by credit card on our site, and I'll show you how to do that in a little bit. There is no profit sharing fee. The history of these things, especially during volatility, has been impressive to say the least. And right now, at least, we're going to stick with a low fixed upfront license fee. And over time, future versions will share in the profits is our plan. But right now, it's sort of like our introductory founders level pricing, if you will. 4 reasons to sign up now. You don't need cash. Like I said, you can have it debited from your account. If you sign up before April 30th, note I didn't say by midnight tonight, like seems like everyone else in this industry does, or midnight tomorrow night. You've got another 10 days here to make a decision. We want you to be fully informed. Take your time. Talk to Infinity. Talk to my team. We'll give you an extra 2 months bonus time as an incentive, because it is important to give you a reason to take action. So check us out. 2 months bonus time. Inventory is limited, and you know, we think we've got some good introductory pricing for you. And with that, let me go to questions, and then I'll go to the website and we can dig in. I'll show you and actually get a lot more. In fact, let me go there right now, then I'll get to your questions. So if you go to InvestiQuant.com/infinity, or you can type in strategies !portal, but go to InvestiQuant.com Infinity, it'll bring you to this page right here. It shows the 4 portfolios. You can click on the details button and get a lot more detail. You can actually do some cool things looking at, okay, so what happened starting in 2016. You see there's that curve I was showing you before. Made all the returns pretty much through May, and then it went flatlined on it. You can scroll down beneath that, and you can read up, understand more of what's in each one. Each one generally, like the 50K has 8 strategies, but it won't trade more than 4 in a day. The 25K has 4 strategies, it won't trade more than 2 in a day. The 20K has 20 strategies, won't trade more than 10 in a day, and so on. So you can back into your total risk. You can look at the maximum drawdown. Again, these are hypothetical numbers. Even though we've been trading these live for a portion of this time, most of the time shown here is is hypothetical. So take this number, and regardless whether it's hypothetical or real, whatever we're showing you, you need to add some multiple to it just to protect yourself. Give yourself some wiggle room. They're pretty conservative to begin with, so you should be able to achieve some pretty we're hoping you can achieve your financial goals. I guess I can't speak for everyone. If some of you want to make 10% every month, and if you're looking to make 10% every month, that's not us. And you need to be willing to risk a whole lot. Anyhow, you can scroll down and get a better idea how it's broken out by month and year, as well at different periods historically.
Scott, can I make a comment here real quick?
Please do.
Okay. So, folks, I want to touch on a couple things that you know, one opinion of mine, and also there's one thing I never really mentioned that I want to clear up about the mechanics of how this works as well. So, and this was I thought about this when Scott was talking about how his account's being traded, because his account is being traded as well. He mentioned his VP of Tech, David, his account's being traded as well, and a number of other investors of InvestiQuant have their capital in there as well. These trades are done in what's called a trade allocation. So a trade allocation is where we place one big order, and then everybody, at the end of the day, we break down the fills into everybody's account based on how many units they're subscribed to. So it's a very transparent way of allocating fills. We do it on an average pricing model. So let's say, in theory, let's say we bought 250 E-minis at the market, and we get filled at 2 different prices. The fills are averaged so that everyone gets the same entry. It's a very fair and transparent way to allocate fills. The regulators like it. It's the way we do things by default here whenever we do trade allocations. So, in addition to the technology, and this kind of speaks to what Scott is referring to in one of the quotes he references about, the hedge fund back office kind of, service we're providing. This has a lot to do with that. That's the stuff you don't really see. It's the way that we, handle the trade allocations. It's a relatively complex system, but we are able to scale it to, very large, amounts of customers and, very, very diverse allocations. Some people are getting allocated one contract and some people are getting allocated way more, depending on what systems they're subscribed to and what, how many units that they're trading. So I know that's a big question for those of you who have ever participated in managed futures or, anything. You always kind of wonder who's getting the fill when and how is it fair and so on. This is the fairest of the fairest way to do it. There's absolutely no doubt in my mind about that. And the other thing I want to mention is, like this 50K portfolio, that I believe it trades, 8 strategies with a maximum of 4 triggering on any one day. That's an account that, from a risk perspective, we would be able to tolerate, someone trading the 50K portfolio, again, with the understanding of the fact that, your performance metrics are going to be increased if you trade with less capital. That's the kind of thing where if somebody's got, $20,000 or $30,000 of risk capital that they feel, they would be comfortable putting in an account like this to see if it has a chance to make money when the volatility does strike. That, if you feel like that's something you could do, then the 50K portfolio, I believe, would be a good starting point. Based on my conversations with my customers, that's where a lot of people find their comfort zone. They don't necessarily need to have all 50,000 in the account. Again, some people have, significantly less, and since it's only trading a maximum of 4 contracts from a brokerage and risk perspective, we're okay with that. But that you want to be, everyone sort of feels really, really smart right now because people who have been long the stock market have made money. Even me. I mean, I'll be honest. I mean, I have struggled with the same emotional, even from being on this side of the business for 13 years. This is where I started my career. I've seen a lot of people come and go, and I've made some of the same mistakes that I lecture my own clients about. It's embarrassing at times, but it's true. And I can own up and face that fact. But I get the feeling that everybody sort of feels very, very, very smart right now because of their success in the stock market, and you just want to be prepared. It's not always going to be that way. If you've made a lot of money back in the stock market and you are in a position to divvy up a tiny piece of it and put it towards something that has a chance to not get crushed when the S&P finally does get crushed, that's the point of this. It's not to replace your equity investments. It's to have a chance to not get demolished when everybody who's just long the stock market is getting demolished. And in my eyes, that's where this fits into the picture. So, Rod made a comment earlier about and not to be pick on you, Rod, the comment about, it doesn't look much better than a mutual fund, on that 1 year rolling period. Sure, that might be true, but what happens to that mutual fund when the S&P is going to be down, 40 points in, a day, 4 straight days? That's really where we believe there's a chance that this can offset some of the losses incurred by normal people who are along the market. Doesn't mean it will. We can't predict the future. Again, a lot of hypothetical assumptions here, but that's generally what what I believe, and that's why we're, willing to, to do this presentation and offer this to our customer base. So I just wanted to mention that part of it.
Good. I totally agree, Patrick. I appreciate the comments and the observation as well. So just to wrap it up here, if you look at the individual portfolios, you can see the details I mentioned. If you want to select one and purchase it, you click, probably should say select portfolio. You can actually combine these and create a virtual portfolio if you want. But if you check the box beside a portfolio that you're interested in, check purchase, and choose your quantity, probably should be just 1 unit. So the 200K in this case would trade up to 10 contracts in a given day. Annual billing, you pay a little bit more for quarterly billing. Purchase the portfolio. You see the price there. Proceed to checkout, and on the checkout page, you'll be prompted for either your credit card or debit my account. So you fill out your information, and at the bottom here, use your debit card or debit directly from your Infinity account. Okay, so that about does it. Let me open it up to further questions. This concludes the formal part of the presentation. I guess I'll summarize by saying we can't make you promises on anything. We're extremely passionate. We have an actual office. We have a team. We've raised capital from our own clients who've used our trading strategies for years to grow our business and offer automated tools. It takes a lot of capital to do the technology right, like we've done with Transact. And we think this industry is in desperate need, frankly, of quality automated systems at scale. And we're trying to do something pretty ambitious, frankly. We're very excited about it. We like our chances. And we hope you'll give us a shot, try us for a year, and see how it works out for you. So with that, I see a bunch of questions coming in, and let me get back over here, and I'll answer them.
I'm going to answer a couple that came through. Okay.
Please go for it.
All right. So
Yep.
IRA accounts, yes, you can definitely trade futures in an IRA, whether it's your own self-directed trading or in an account like this that's being traded through what we call an LOD, or a letter of direction. We don't have any special restrictions like what you can or can't do in your account because it's an IRA, but just be generally conscious of the fact that it's your retirement money, and you should still consider it risk capital. You guard it, obviously closely. If you've got an old 401k from an old job that you forgot about or something like that, and you want to, you're okay putting that capital at risk in a futures account, that's okay. If you absolutely need your IRA money in a year or two, you may want to reconsider, or at least, be very modest with what you start with. Okay. Rod also asked, like lockups. There's no lockup period because this isn't a fund. It's your futures account with your own name on it. That's one of the benefits of something like this. There are a lot of benefits to futures. There's tax benefits. You get 60-40 tax treatment if you make money. But the market that these guys are generally going for, based on my observation, is they're looking for people, not just the 25 and 50K type portfolios, but they're looking for some folks who would otherwise put a few $100,000 in a hedge fund. But there's all kinds of negatives associated with doing that. It gets locked up. There's withdrawal penalties. Maybe your money goes to the Cayman Islands the next day. I mean, who really knows what's going on? You get a quarterly statement. You don't really know. Here, you get a futures account statement every night with your name on it. You can liquidate the money tomorrow. It's your account with your own money. It's not a fund. Your money doesn't touch, another futures account. You're not pool. There's no pool. So that's a really important distinction to make. So I just wanted to touch on some of those mechanical, sort of questions. Go ahead, Scott.
Well said. So let me see. Other questions? There's a question, normal logins that we can monitor in real time. I guess that's for you, Patrick.
Right. With this sort of because the trades are done in an allocation, you're not going to be able to log in and see the trade happening in real time like it was your own account. Basically, what I was mentioning earlier, Greg, is the fact that the trades are done in an allocation account means you don't have access to that allocation. It's something that we're managing on our end. So the trades are done in like an account number that is not really a futures account number with someone's name on it. It's in an account number we're managing specifically for that allocation. At the end of the day, we break those fills down into everybody's statement. So it's going to feel more like an account that's being managed in that, you log in at night and see the statement. You're not going to be able to log in intraday and see the trade actually occurring at least anytime soon. I don't think that will be changing, but you will get a daily statement. If you have an account with us already, then it'll just appear like a different page on your daily statement, and you just scroll down through your own trading, and then you'll see the InvestiQuant activity on the next page.
Stan says, why do the returns vary considerably with the different account starting balances? Because the portfolios, so there's a different portfolio that's a group of individual strategies for each of the starting capital amounts. Some of them are included in the other ones, and it's disclosed in the View Details button that I just showed you on our website. If you click on View Details, for example, the 50K is in the 200K portfolio, and I'm not positive the 25s and the 50. But that means the 50K can only trade up to 4 strategies in a given day. The 200K can trade 10. So there's 6 other different strategies. So for whatever reason, those particular strategies in the 200K affect the performance differently. They're different, slightly different markets, different targets, similar strategies, concepts. So it's just a little bit of randomness in that regard. We're trying to make them as balanced as we can because we want everyone to be successful. We absolutely do, but there is a limit to the diversification we can put into the smaller portfolios, and that's just the reality. So,
right.
Tell people don't put all your eggs in one basket.
Right. Another one. So a couple other questions for me, sort of. You can still trade your own account. So if you have an account with us already, or you're in the process of opening one, this activity will happen in what we call a sub account. So a sub account is a different account number that's associated with you, and it shows up like a separate page, like I mentioned on the statement. It's not going to get mixed up with your own trading. So you're going to see clearly defined on your statement, your trades and then trades, done through the InvestiQuant strategies. And Drew had asked, do you see the actual trades on the statement? And the answer is yes. So when you get the statement, you're going to see the actual buys and sells, and then you may see the word or the abbreviation AVG, which means average, which basically means that we're averaging all the buys and then all the sells, and everybody's statement shows the average price. So in what that means, like I mentioned earlier, is that if we do a trade and we get filled at, say, 2 different prices in the S&P, the average fill could be between 2 ticks. So we're going to show an adjustment to, for that. But that's how the average pricing model works. And then Greg had also asked, and I don't know if you want to comment on this, Scott, I'm not sure there's a need to, but Greg had asked, are bracket orders always being used with the stop order reaching the exchange on entry? So there's not always a bracket in that there's always a stop and a target, but there's always a stop. So if the system's operating normally, and of course we are watching things, so if we have to do something manually, we can, of course, but there's always a stop going in. And I don't know exactly what, how this decision is made or not made, but I can tell you from the brokerage and execution standpoint is that sometimes there's a target, and sometimes there's a really, really, really far away target that is designed to be an open target, really. And then there's a time-based liquidation, like if by noon or 12 or excuse me, noon or 2 or 3 o'clock nothing has happened, meaning the stop hasn't been hit, and that really, really, really far target hasn't been hit, then they just close out at market. For example, like at 3 o'clock Central Time. So that's been my experience.
Yeah, that's exactly right, Patrick. Today we had we had a little bit of everything. So we had a fade off the open in the YM that was stopped out for a loss. We had 4 follows in the ES. 2 of them, the ES is the S&P futures, 2 of them were for intermediate term specific volatility-based targets that were closed out early in the day because they were hit pretty quickly. And then we had 2 that were held all the way till the very end of the day for nice wins to the long side. I've also put up here, I forgot there was one slide, tips for success with IQ portfolios, and I mean this with all my heart, and I guess I thought I was done, but I've got one more slide here, and I really appreciate everyone's patience. I'll probably need to let the Infinity folks go, and happy to take additional questions. In fact, let me post my email address. But I know everybody wants to make money. They want to make it overnight, and they want to make it every day and every week. And if that's really what's in your head, then we're not the right person for you. I'm trying to post my email address. Patrick, can you post it or have one of your folks, or maybe Matt, post my email? It's Scott at InvestiQuant. For some reason I can't type in there. Scott, S-C-O-T-T, at InvestiQuant.
Okay, I posted that in the chat there, so everyone should have that.
Great. Great. Anybody that wants to email and you have questions, please feel free to fire away because we have taken a long time, and I really appreciate it. We've had tremendous interest in questions. This is hard for people to get their head around, and it's going to sound like I'm trying to convince some of you not to sign up, and that's not the case. I just want you to, if you do sign up, come in with realistic expectations. I've traded thousands of futures trades. My own personal equity chart, if I were to show it to you, would be marked. If you looked at it closely, you'd realize, holy cow, and at first glance it looks great. It's gone from bottom left to top right. Nice zigzag back and forth. New equity highs followed by drawdowns. But so people get excited at first, but if you think about it, when you look at an equity chart and think about how trading really works, you're almost always in a drawdown, meaning your account equity is almost always somewhere below its all-time high. Unless you're literally taking trade after trade after trade after trade every single day or every day that you're making money, which doesn't exist. It's impossible. They do not exist anywhere on the planet. Yes, can you do it for 3 months? Yep. Can you do it for 6 months or a year? Yep. In fact, we've got one of our clients has had 32 consecutive winning trades, swing trading with some of our data on our website. Okay, 32 consecutive trades. He's convinced we're an ATM, and we keep telling him we're not. It will end. But over the long term, quantified edges are a great edge, but you're going to have run-ups, and you will have periods of sideways and down, followed by run-ups. That's at least what's happened for me for more than a decade in my own personal accounts, and that's just the way the markets work. But most of the time, I'm below my equity high. So the name of the game here, it's very difficult to time. Get into a portfolio and just give it a year. Give it time to let the markets, let the volatility come in, and let's just see how they do. I can't guarantee the portfolios will work for you. The more time you give them and the bigger portfolio you use, the better your odds. I believe that. But we think we've got quality products. We'd love to have you join us. We've got a couple of the tips there. Just be patient. Protect yourself. That's all important. We will do our best to protect you. I know Patrick will do his best to protect you, but ultimately it's your capital and your money, and you want to manage it accordingly. So, Chris, a couple more questions, and I've got to go. Let you go and let Infinity go. How many contracts are entered for each strategy with the 200K portfolio? Each strategy will only trade one contract, so we're trying to go for diversification. The most strategies that could trade on a given day is 10. So half of that, and that's very rare. It may happen a few times each year. A more typical day may be 3 or 4, 5, 6 strategies may trigger in a day, and they trade one contract each. And with that, I'm going to wrap it up, turn it over to you, Patrick. Thank you all very much for your interest. Feel free to email me again, or Scott at InvestiQuant, or support at InvestiQuant, and appreciate your time and interest. Hope to have you on board. Take care.
Excellent. Thank you, Scott. No, I really appreciate that. That was very enlightening and excellent presentation. I think we got pretty much all the questions answered. If anybody has questions about the mechanics, the execution, what are the opinions that we have from a brokerage standpoint and a risk standpoint, that's our job. If you have questions about the personal risk to yourselves, if you want to discuss your personal situation with respect to risk capital, which one of these things might be a good fit, that is something we are permitted to have a personal discussion with you about, because we are registered. That's our job. So certainly, if this is something you're considering, have a conversation with your rep in our office. We have a number of these portfolios all trading live right now. They're running every morning, and if you want to discuss any of them with us, of course, we'd be happy to do that. If there's no more questions for me, I'm going to read some risk stuff here one more time, and then we will we'll close the room up, and barring any unforeseen issue here with Go2, which it looks like there isn't going to be one, we will have a recording, and we'll throw it up on the YouTube page and send that out to everybody who signed up. So we certainly appreciate you coming. Thank you so much for your attention. Please send your questions our way, and let's talk about it. If you feel like this is appropriate for you, we're happy to discuss. All right, folks. Thank you so much. Trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All righty. Thank you so much, everybody. Have a great night. Thank you. Bye-bye.
Thanks, Patrick, and thanks to all the Infinity folks as well. Take care.